Well, thanks for tuning into this broadcast. On the sidelines of the J.P.Morgan India Investor Summit, we have Latika Chopra, who tracks, well, amongst maybe other things, consumers very, very closely in such an important topic. So good to have you, Latika. Thanks so much for joining in. Hope all is safe.
Thanks for having me.
The pleasure is ours. Latika, what's your sense about how would investors approach the Indian consumption basket, considering that Q1 showed some fairly stark differences between FMCG, which I believe you track very, very closely, versus some of the other discretionary items?
Sure, Niraj. I think there are two lenses which investors can use to look at consumption stocks. I think one is more near term, if you're talking about next 3 to 6 months. Clearly, some of the trends which are very visible even in Q1, like health, hygiene, I think these are going to remain fairly strong along with that at-home consumption. The momentum for stocks which have exposure to these particular aspects will remain fairly good. But for investors who are willing to look a little longer, say next 6 to 12 months, I think categories like personal care, out-of-home consumption-oriented spaces will also get back into more traction. I think there's another cohort where companies which have a fair more exposure towards online channels will continue to do better.
Okay. Then I probe the last point before we talk about some of the others. So we saw a lot of these FMCG names. I'm using names as examples, of course. I know you can't talk about stocks, but a lot of these companies kind of tried to some online sale methods, right, of sorts. Marico did it, others did it, etc. So would you reckon that there is an equal adoption for most, or are there some which traditionally have been stronger in some limited way in this, which might be able to do better than the rest?
See, online channel was already gaining a lot of prominence even pre-COVID, right? So the companies who are at the forefront of it in establishing capabilities to tap into this channel stand to benefit relatively more, in my view. This pandemic has been more a wake-up call for companies which were not as well adapted to into this channel. So I think for those companies, probably just go around how we tap into this space, but e-commerce already accounts for roughly 2 to 4% revenue share for most FMCG companies. Clearly, there's a step-up increase in the share of online, and I believe this will be sticky even as we look beyond this pandemic. Interestingly, we will also see that the modern retail players, the offline players, increasingly are moving towards Omni mode as well. So we really will see traction in the e-commerce / online space.
Interesting. Because now we have a formation of a real large behemoths, if you will, on the other side, right? So hitherto, the common narrative, Latika, has been that FMCG companies have been able to bargain well with the mom and pop stores. They might not be able to in the same fashion with the retail giants, and therefore could, over a period of 5 years, 10 years, that bargaining power and thereby costs, thereby margins, etc., come under a bit of threat. Is there any stargazing that you've tried to do here?
Still early to say how things pan out over the next 10 years, but let me say that when modern trade came into India about 15 years ago, I think we confronted with similar questions, and I realized there were certain companies who actually tackle this issue pretty well by being more agile, about the portfolios that they choose to come out with, how they dealt with these channels, and at the same time, they actually strengthened the capabilities in the mom and pop store channel. And please do remember, 75 to 80% of the grocery retail channel is still accounted by these kirana outlets. So I guess this, all channel will coexist. Of course, moderate / e-commerce channel will gain more prominence. Question is whether FMCG companies will be more agile to deal with it. It'll become even more critical for them, to be on the top of the trends, to accelerate the innovation, and of course, continue to be on top of the mom and pop channel. I think already we are seeing more and more FMCG companies trying to enhance their direct distribution reach, trying to work along with kiranas in their digital transformation.
That's true. Okay, the other bit was the fear that was very widespread, especially in the months of May, if I'm not wrong, May and June, that or April and May, as the case may be. And a few of your peers had come out with those notes as well. Maybe you had to about possibilities of down happening. Now that, I mean, what's your assessment from April till September? Has there been visible down trading? Have companies on the conference spoken about that more in the products? And part two of my question related is that therefore companies which have a higher premium portfolio, would they be at a higher risk, earnings risk, as compared to companies with a more basic portfolio wherein the fear of down trading might be limited?
Okay, there are multiple dynamics at play here. Clearly, post the pandemic, value consciousness has risen among consumers and has been reflected in consumer opting for low pack sizes, at least for most FMCG companies. However, at the same time, consumers have been very conscious about what brands they choose. They should be trustworthy. And hence, there is a market share shift which is clearly benefiting the larger branded players at the cost of unorganized players, right? I think there is also, a play of the channel mix here, right? So rural, where you end up seeing a higher share of mass brands is relatively doing better than urban, and as we discussed, modern trade has been impacted. A fair that used to be a channel where you sell premium products. I think your second part of the question, I guess it's well known. Clearly, as I mentioned in my earlier comments, personal care, out of home, a lot of premium gets connected into those categories will come back later. And I think that to a large extent probably is already known and probably is getting factored into earnings forecasts as well.
Okay. Final question, Latika. I don't know what's your view on and what kind of coverage on the non-discretionary side do you have, if you do, that is, but what's your view largely on discretionary versus non-discretionary? Is non-discretionary or staples much safe to be in right now, and would the valuation multiples that you would be comfortable assigning stay put versus the others?
So again, both discretionary and non-discretionary have various subsegments, and I think stocks in each of the categories have different drivers. And since I cannot talk about stocks specifically, but at a broader level, our India strategy team has an overweight on staples versus discretionary. So that's one part of it. I think on your question on valuations, it's not necessarily just a function of how you're viewing things right now, but also what kind of faith or conviction you have in medium to long-term mix of staple stocks. And I think that looks fairly promising. Though valuations have moderated, somewhat over the last month or so. But on a relative basis, when you track multiples versus the broader markets, I think those are at still very reasonable levels in line with the historical averages.
Okay. Great. Latika, it was nice doing this brief chat with you. Thank you so much for taking the time out and speaking to us. And more importantly, stay safe.
Thank you, Niraj. Have a good day.
Thank you. Thanks for tuning in.